Okay, so let's briefly talk about goodwill impairment. And so, if you recall from intermediate accounting, what you have to do here as far as goodwill is concerned, of course, it sits there on the books. It's not amortized because it's got no definite life. But what management is required to do under ASC Topic 350 is that they have to um, assess whether or not goodwill is impaired, and that assessment has to be done at least every year, if not sooner. Sometimes if, say, mid-year, there's some issue that indicates that goodwill is impaired, then they would do it sooner than uh, end of accounting year. But definitely they have to do it at the end of each accounting year. And so what the FASB requires is that because there was a lot of complaints that having to do this analysis, if you have to go through this quantitative analysis, which requires, in some cases, pretty substantial uh, valuation studies by valuation experts, which can cost quite a bit of money. What FASB has done is kind of backed off and indicated under ASC 350 that first you have to do a qualitative analysis. And so if you do the qualitative analysis and it's more likely than not, meaning greater than 50% chance that goodwill has been impaired, then and only then do you have to do a quantitative analysis of the impairment of goodwill. And the quantitative analysis is a two-step process. Well, so, some of the things they talk about in this qualitative assessment, what you would do is look at things like macroeconomic conditions. So, if there's a general deterioration in the marketplace that would affect the company's values, then the subsidiary's values, fair values of its assets, then that might be one qualitative factor. Industry and market considerations is another. Factors such as cost of raw materials for inventory and just overall financial performance of the subsidiary. And understand that this goodwill is analyzed at the respective operating unit that utilizes the assets that are tied to this goodwill. So what does that mean? What's an operating unit? Well, of course, certainly a subsidiary would be an operating unit. You could go even further than a subsidiary if they have different divisions within the subsidiary. The goodwill would be attributable to the division whose assets are utilized by that division, and the assets are tied to that goodwill. Remember how you come up with goodwill. Well, what you do is you look at the consideration given. You deduct the consideration given. Well, you deduct the book value from the consideration given to come up with the excess consideration, and then you determine the excess fair value of the assets, or the net assets, which is assets minus liabilities assumed in the transaction. And so recall that you allocate the excess payment to the excess fair values of those net assets. And any excess consideration after allocating it to the excess fair value of assets, net assets, is assigned to goodwill. And so that is how that works. And so my point is, the division or subsidiary or whatever you have that utilizes the assets that are tied to the particular goodwill that's being analyzed is where you do this, not at the corporate level, the parent level. Understand also that when you're doing this analysis, especially when it comes down to the quantitative analysis that we'll look at here, it's not like you can really go and look at goodwill and say, yeah, you know, that goodwill, it's gone down in value. I mean, it's not like an asset. There's no market value for goodwill. And so the only way you can determine if somehow goodwill is impaired is by looking at the underlying assets that were allocated as a part of the overall goodwill allocation. And we'll look at how you do that here in a minute. All right, so what happens if you determine that after you do your qualitative analysis that there's a greater than 50% chance that goodwill's impaired? Well, then you have to go through this two-step process. The first part of this, step one, you have to determine whether the carrying amount of a reporting unit is more than its fair value. And so if the carrying amount of a reporting unit is more than its fair value, then you go to step two. If the fair value is more than the carrying value, you can stop at step one. You don't have to go to step two. Okay, so if fair value is greater than carrying value, book value, not book value, but carrying value, remember you've got that excess allocation, stop. You don't have to go to 2. But if fair value is less than carrying value, then go to step 2. Now, didn't we just do this, is the carrying amount of a reporting unit more than its fair value, in the qualitative analysis? Well, yeah, you kind of did. The big difference is that in the first instance, you did a qualitative analysis, whereas here it's more detailed and probably, depending on certain factors, requires certain valuation and analysts, experts to come in to help you do the quantitative analysis, which can run into some pretty good amount of change. So this was the argument for why company executives wanted the qualitative analysis first, and then, if there's a greater than 50% chance that the fair values were less than carrying values, then go to the quantitative analysis. Okay, so that's really what step one gets down to, is whether fair value is more or less than carrying value. If fair value is less than carrying value, go to step two. In step two, this is where you have to go through and let's see here. Show you the following. Should have had this pulled up before, sorry. But anyway. Alright, so let's go to chapter 3 and let's look at Goodwill Impairment here in the book. So if you look at how they do it here, you've got a situation where this new call is a brand new company, and what happens is you have a merger between DSM and Vision Talk. So new call is created so that DSM and new call can be merged into, DSM and Vision Talk can be merged into this new corporation called New Call. And so on top of that, the new corporation has operating units or reporting units, and notice here that they've separated two parts of DSM. So they have not only a subsidiary, DSM, but they have divisions. So division 1 would be DSM Wired here, and the second is DSM Wireless. And so they are reporting goodwill at the reporting units that who utilize the assets that are tied to particular goodwill. And so in this case, you've got DSM Wired, goodwill of $22 million, acquisition date fair values of as of January 1, 2017, the date of this merger. DSM Wireless, goodwill of $155 million, acquisition date fair value of $748 million, and then Vision Talk, the other subsidiary, goodwill of $38 million, acquisition date fair value of $502 million. All right, so at the end of 2017, New Hall performs a qualitative analysis for each of its operating units or reporting units to assess potential goodwill impairment, and New Call examines the relevant events and circumstances that may affect the fair values of its reporting units.
The analysis reveals the fair value of each reporting unit likely exceeds its carrying amount except for DSM Wireless. So, of course, that's a big bulk of the goodwill involved here. Step 1 of the Goodwill Impairment test then reveals DSM Wireless's fair value has fallen to $600 million. Well below its current carrying amount. New Call attributes the decline in value to a failure to realize expected cost-saving synergies with Vision Talk. Then in step 2, New Call compares the implied fair value of DSM Wireless goodwill to its carrying amount. And so to do this, they take the fair value of DSM Wireless overall, compare it with the fair values as of DSM Wireless as of 12/31/17. So they had to have somebody come in and assess the fair values of all these assets and liabilities. Brand new valuation separate from their valuation on January 1st, the date of acquisition. And so here, the net assets are valued at $596,000. Well, just like we did before, if the fair value of DSM overall is $600,000 and you can attribute that amount to $596 million of net assets, then it's assumed that the excess is attributable to goodwill. Well, they have it on their books at $155,000, and the excess amount of fair value over the value of the net assets is only $4 million, and so they're going to recognize an impairment loss of $151 million. Now, there could be a situation where all of the goodwill could be used up. My point here is you can never take a larger impairment loss than the carrying value of the original goodwill. In other words, you couldn't go and you could have a potential loss total of $155 million, but you could never have a potential impairment loss of $156 million or something even higher. So you have to stop when goodwill gets to zero. All right, so that's how you analyze impairment loss for goodwill, and I've assigned a problem very similar to this. Understand that there has been a proposal to simplify this, and so that was done on May 16th, and essentially what it would do is do away with step 2 of the quantitative analysis. And so there's an example here on page 120, this RNT reporting unit. And so the carrying amount, of course, they do their qualitative and then quantitative analysis, step 1, and determine that the fair value of RNT reporting unit as a whole is $1,500,000, and the carrying amount's only is more, $1,625,000. So instead of going to step 2, what you would do is simply take the $1,625,000 less the $1,500,000 fair value, or better yet, actually $1,500,000 less the $1,625,000, and so that's your impairment loss, $125,000. Now note that there's enough goodwill to absorb all that difference between fair value and carrying value. If, let's say, carrying amount was $1,725,000 and goodwill was only $148,000, you would be limited to goodwill impairment loss of $148,000, the amount of the goodwill on the books. So just realize that. So that's the proposal. It'll probably save a few bucks for companies. All right, that's it. Thanks.